Welcome back, everybody, to another monthly Alliance Academy webinar. I'm Chris J. Snook. I am your moderator today, and I'll be getting out of the way here shortly. But this month's theme comes off of the heels of Jay Powell's first rate cut in years yesterday. And we're going to be talking about the still looming $2 trillion debt crisis in the CMBS market and what that all means to you, both as an allocator as well as an asset owner. I'm glad you're here, ready to go through this rapid fire session with the one and only Ben Reinberg. Again, just for those who are new, Alliance Academy exists to help you find the signals amongst all the noise and try and take a level-headed approach and action off of those insights based on the metrics that matter. And when the market is flying blind, like it is right now, or just riding momentum, that is more valuable than ever. So with that in mind, let me just get out of the way and welcome our host, Ben Reinberg, to the show.
Thanks, Chris. Appreciate it. I'm excited to be here again. We had a growing number of registrants for this month's topic, which is exciting. So thank you for everyone who's joining us live, or if you're catching the replay, we want to tell you we appreciate it. And for those of you that are new, I'll give you a quick background and then we'll dive in, Chris, okay? Yeah. Over the last 30 years, I've acquired and managed commercial real estate around the United States, always with a focus on three things: 1, cash flow; 2, appreciation; and 3, tax efficiency. I'm going to repeat that again: cash flow, appreciation, tax efficiency. Our investors include accredited high net worth investors, family offices, and professionals all throughout the world that want to build durable wealth. And Chris, the one thing they all have in common is they don't chase, they don't prepare, and they track key metrics. They know their data and they move smart. That's who our investors are. And speaking of data, I'm going to give you some recent facts for context before we get started today, so everyone knows what is going on in the marketplace. There's $957 billion of commercial real estate mortgages that mature in 2025. And 20% of the $4.8 trillion stack of loans that are coming due with cumulative maturities is topping, Chris, $1.5 trillion by the end of 2026 as extensions roll forward. This is the wall we're managing against. This is the lack of liquidity you see in the market with lenders. About half of those maturing loans sit on bank balance sheets. So banks' underwriting posture is the transmission channel for market stability or stress. And the Fed's cut haven't fixed the math, Chris. It's the front end ease, but long-term rates and exit caps remain really sticky, leaving maturing loans underwater at today's value and debt costs. That came from Cushman & Wakefield. And according to Moody's, distress is building. By early 2025, distressed commercial real estate topped $116 billion, and default shares tied to maturity events keep rising, especially in conduit and CMSB. Directionally, Chris, delinquency rates have marched higher through mid-2025. So you could see there's some stress in the market. And extensions buy time, not solvency. The regulators are coming in, and trade groups still flag this slow-moving train we have. So there's tight lending, rolling maturities, and valuations that haven't been repaired, which is counterparty risk inside the banks. That's why you see a lot of the banks are skittish in what's going on in the marketplace.
Well said. So, a lot of do me like type data, not new data, things that you've been talking about or writing about on the intelligence newsletter for the last year, but kind of coming to, a present day thing again, amongst all the hype around rate cuts and the forward-looking future of that. But today we're going to talk about the fundamentals and 8 core metrics that investors, operators, allocators, whether they be passive or active, should be tracking. And in this unpredictable market, what you measure basically is what protects you. So today, guys, what you'll leave with is a sharper lens, hopefully, for evaluating real risk in your portfolio, a smarter framework for navigating rising debt, liquidity shocks, and refinance cliffs, and a clear playbook from Ben for seizing opportunity before the herd even knows what's coming. So let's get into it. Let's go through a rapid fire, framework of these 8 metrics that you measure to and manage against. What's metric number 1?
Well, metric number one, Chris, is debt service coverage ratio. If you look at your net operating income of a property and divide by your debt service coverage, that's your DSCR. That's what we look at. And if your DSCR trends below 1.25 times, you're flying a little bit too close to the sun, as we say. So what we're doing at Alliance is we're modeling day one coverage at greater than 1.25, and then stress testing rising debt costs, modest rent declines, and a slower lease up to make sure coverage holds to protect your downside. And practically what that means is, retrading service contracts, tightening operating expenses, and sequencing CapEx only where it drives NOI in 90 to 180 days. So we only pursue interest-only windows or modest buy downs where lender posture allows, but we don't underwrite to those. So a good acquisition tactic is to build structured cash reserves at the deal level and add a small fund level buffer to smooth out short-term DSCR dips without triggering covenants. And that's a really important point.
Awesome. So talk about the second metric.
Well, the second we look at is we're looking at cash on cash returns in this current environment. So cash is king and always has been. Great cash flow. So we shifted targets away from 3 to 4%. And on stabilized assets, we're looking for 6 to 8% cash on cash as the floor, with an unlevered cash on cash sanity check to make sure that the yield stands up without a debt, what we call the debt fairy dust. And so it's called an unlevered return is another word for that. Then we underwrite tenant quality, competitive supply, and nearby vacant land pipeline. We want to see the barriers to entry that compete with our properties. That could create new inventory against us. So if the unlevered yield, that return, can't carry higher for longer, then we're going to pass on the opportunity.
Awesome. So as we do this, guys, if you have questions, whether it's from the YouTube stream or whether it's native into StreamYard, just post those in the comments section, and we'll look to get to as many of those as we can. Let's move on to metric 3.
All right. Metric 3 is loan to value. So loan to value is if it's too aggressive now, you're putting a noose around your deal, Chris. And we're seeing lenders, they prefer lower leverage, 60, 65 today, with some even lower than that. And it's especially tighter for urban office or mixed use. So over leveraging property is not going to happen in this current market. Leverage is not a strategy, it's a setting. And so we're operating at 60, 65 LTV versus, maybe an older cycle where you can maybe lever it up a little bit to build downside protection and keep flexibility with the lenders. That's really important. That is the key to our business. And if it's urban office or mixed use, the bar is even higher. So equity today is cheaper than losing the asset tomorrow is a real lesson that is out there that you need to understand. So I'll repeat that. Equity today is cheaper than losing the asset tomorrow. We always make sure we have enough equity in our deals to protect our downside.
Yeah, I think that's one thing, you've talked to me about a lot, that you've learned over 30 years is that very thing, right? Your ability to hold and
ability to hold.
Yeah. So, all right, moving on to the hump day, fourth metric that you consider.
Well, fourth metric I consider is interest reserve and recast risk. So this is where deals get nuked. This is where you have issues. We model full rate exposure, including current swap rate curves, and we add 10, 12 to 24 months of interest reserve for bridge style paper or transitional assets. So wherever possible, we pre-negotiate cap triggers, extension tests, and cash sweep mechanics before we close. If the only money available is 11 to 12% private debt with a 12 to 36 month balloon, Chris, we cap the LTV 50% or less, or we don't play. It's just too risky. So the goal isn't to survive, it's to avoid the buzzsaw.
Yeah, got it. Yeah, I was going to ask you that, but you kind of answered it already with regards to what do you do if the current valuation of the property is upside down and the LTV, doesn't meet that 50%. Let's say there's like a 30%, issue in there. I mean, what's the fix for that? And
the fix is its ability to hold. Don't over leverage, especially if your cost of capital is going to be more expensive. And so you might have to pay investors a lower yield. It's all about getting through another day, paying cash flow, and making sure you preserve the integrity of the property. So ability to hold is the key to commercial real estate. That will never change.
Cool. So then let's talk about number 5, because it kind of talks to you about on the other side of why it benefits you to be able to hold. So let's talk about number 5.
Well, number 5 is the refinance horizon. It's really your runway and how you manage it. So let's say your refinance is inside 18 months, you should be in the market. Inside 6 months, and you're late, you got to start hustling. So you want to give yourself a long enough runway to trim vacancy. So you might trim vacancy, you might extend key leases, which we've done. Make sure you have clean estoppels and lock in any last NOI growth you can have, which is a win. And so we try to engage at least 12 months out, get term sheets in to renegotiate. That way, if the market breaks our way, we have the ability to handle it, and try to keep a very favorable position for us. So with banks holding approximately 50% of maturing loans, the earlier you demonstrate stability and liquidity, the better the terms you get. So this is why, Chris, I preach it's a relationship business, because when things are tough and you can pick up the phone with your lender, that's a huge win to have a conversation. Having a conversation and building rapport and credibility with your lender is key. And it will always be that way. It's one of the keys to my success.
Yeah, and down at the granular level, inside of the workout desks and inside of the actual institutions, right? Because people move around. But if 50% of banks are holding this $2 trillion ish worth of CMBS, then they all have an issue at some level. And so the relationships that you build 10 years ago, 15 years ago, like you have, may not be with the same place, but that place has the same problem. And so that becomes an opportunity to, get in front of the line or cherry pick deals when they can't find somebody else to acquire them at the terms that they've agreed to. Right. Mm-hmm. So I know you work really hard at that and have for the life of your career. Let's talk about metric 6 now. So let's go into the 6th one.
Yeah, let's get into the meat of it. So it's cap rate spread versus the 10-year treasury and the right benchmark. So we have a rule of thumb on acquisition. We're looking at approximately 250 basis points plus over the match duration risk-free rate, we call it. In practice, that's the 10-year U.S. Treasury for core plus, or the 7 to 10-year swap for fixed rate structures. And for floating rate execution, we also look at the SOFR. The SOFR took over LIBOR, for anyone that doesn't know that, plus a credit spread and demand commensurate risk premium. So if we can't capture that spread with today's in-place NOI, not pro forma fairy tales, we're talking about in-place NOI, we won't stretch, because the refi math, Chris, will punish you if long-term rates don't fall as fast as the Fed's front end. So 250 basis points guidance is a starting discipline, not a law of physics. And it must match the financing profile, like fixed versus floating. What's your business plan risk, your tenor for risk. So we look at higher vacancy, weak credit, or heavy CapEx should widen that required spread. So conversely, bulletproof tenancy and a long-term weighted average lease term can narrow it slightly. And what we won't do is buy tight to the 10-year treasury and pray for a multiple expansion. You have to be very cautious and conservative. It's why investors invest in Alliance's investments, because we are outstanding at placing debt. And it's a holistic approach you got to look at.
Yeah, gotcha. Thanks. I see some questions. We'll get to those here in a minute. But that was actually a really interesting breakdown of how you look at the 10-year and the spreads and kind of what you bake in. Like you said, it's not physics, but it's a starting point as a discipline, especially in today's market where the 10 years acted wonky, compared to historical terms. So it's a good place to start. All right, let's talk about number 7, and then we'll round it out, and then we'll get to some questions. I see some coming
in. It's the NOI and occupancy trend lines, we call them. So one soft quarter happens, 3 in a row, or a vacancy shock means in value compression territory. So how we work, our defense is concentrate in needs-based, durable demand tenants, medical, veterinarian, logistics, and start renewal talks 6 to 12 months out early and trade minor. What we like to do is trade TI for longer term and escalators. And we also sequence CapEx towards revenue attached projects first. We try to keep that NOI as high as possible because stability is in the alpha, and in the maturity wall, stability is the alpha. So that's exactly what we have to do.
Yeah. Let's finalize with it. Kind of relates to that metric number 8, and back to your concept earlier of the holding. Like, what's your kind of discipline for that, right?
Well, it's your liquidity coverage ratio, right? The key to commercial real estate is the ability to hold, and the ability to hold. That will never change. And can you hold for 12 plus months, 24 months? What kind of reserves you need? So you have to ask yourself, is if rent stalls and debt costs don't ease, can you survive 12 months without forced selling to be able to ride waves? Because real estate cash flow, Chris, are like moguls, right? So you got to ride it until you hit the peak, was when the right time to sell. And, we've target deal level reserve fund levels, at liquidity coverage ratios that protect distributions and covenant headroom. It's really important. So given bank caution, rolling maturities, optionality is the asset. Cash, undrawn lines, structure waterfalls that auto throttle, the GP or LP's cash flow if metrics tightening. So the optionality or the flexibility, we call it, is what lets you buy time and opportunities when others can't. So it's always going back to that principle of the ability to hold.
So without getting into the details that maybe aren't possible, what is the kind of takeaway for how you're managing the balance sheet based on all that today?
Well, we're going to keep capital reserves in the bank at the fund level, and plus structured waterfall triggers that protect investors' distributions. So it's not about hoarding cash. It's about buying time and optionality, which is, again, the ability to hold.
And I do know, you're actively pursuing, acquisitions and deals, and you see it as an opportunistic market, but it's also, it's a muddy one. You're getting your hands dirty and rolling your sleeves up. Right?
Mm-hmm. Yeah, that's correct.
Well, let's recap this in a second, but we have a couple questions, so let's drop into those. Michael, our buddy from Canada, actually, Michael's got a question. Do you have a favorite hunting ground? Meaning, what states do you favor, and which ones do you stay away from?
Well, it depends on the asset class, Michael. It's a great question because it's something I created years ago. Being from Chicago, that's where our headquarters were. I saw that there was a lack of growth at one point in my career. So we decided to go into the South and the Southeast and the Southwest. So we focus a lot of attention for different asset classes in the South, Southwest, Southeast, Mountain West, because that's where population growth is. That's where pro-business growth is. That's where families are establishing roots. And so I like to go with the trend of where people want to be. So for medical properties that we acquire, or veterinarian, if there's population growth and families establishing residences in these areas, it's a natural fit for us. So, but asset class like medical, you can buy around the United States. Anyone needs medical service. The human body is never going to style. When it comes to multifamily, we're looking down south, but we're also looking in markets up in the Midwest too that are great markets that have great value for multifamily. Industrial, we like 24/7 cities where they have 3 shifts a day. Port cities are great, like a Savannah, Georgia, Miami, where there's a lot of activity coming in and they need distribution. So those are some of the areas that we look in. But at the end of the day, it's where's the population growth? Where's the density? How do you protect your downside? How do you have the ability to hold with supply and demand generation? It's a great question because I ask myself that question constantly. Where are we investing?
Do you think any of those are overbought at present?
Depending on the asset class, it could be. There's going to be pockets of market where it's overbuilt. It's over, it's got issues, but you got it. This is why, Chris, people invest with us because of the 250 plus years of leadership team experience to understanding how to underwrite and knowing the real estate fundamentals. It's why I talk about it significantly, especially on social media. We talk about a lot is, you have to invest with smart money. And I talk about it in my new book, which is, for anyone who hasn't picked it up, it's a great resource for you and your kids. It's hard asset and hard money for hard times. And it gives you an inside look of what we do at Alliance. And, it comes back to the ability to hold.
Yeah. So where would they go to get access to current deals or find out kind of what's on the horizon for the fund or the portfolio? Where's the best way for them to?
Well, I think the best way is to become an investor. If you go to alliancecgc.com, that's alliancecgc.com, and you click on invest with us, you can fill it out and we'll have someone reach out to you. And that's the best way to get in our universe. You can start investing with us. We got a great track record. We understand commercial real estate and we have different asset classes that you can invest in. Now, if you want to learn more about me or you want to learn about investing commercial real estate or want to follow me online or learn more, or you want to buy a book to learn how to build a hard asset empire and invest, as well as with the Alliance Academy, the courses that follow the book will bring the book to life. So you can take courses as well. We have a plethora of data, not only on benreinberg.com, but also on alliancecgc.com. So a lot of resources. On Alliance CGC, we have testimonials from all different people we do business with for years. It's very transparent and it's just great tax benefits if you invest with us. If you like creating paper losses so you can use them against other passive investments, it's a really opportunity to invest in with Alliance right now.
That's awesome. And we have kept to our promise of keeping this to under 24 minutes. We're at 22 and a half. So I'll let you take us home from here.
All right. Well, thank you for tuning in, everyone. And we look forward to seeing you on a future webinar or a discovery call, how Alliance can help you and your family build wealth. And we can end up being your final destination for financial wealth for you and your family. So pick up a copy of the book if you're interested. Feel free to take some courses if you want to continue to learn. And if you want to invest passively, just go to alliancecgc.com, click on the invest with us, and we will get back to you right away. And we'll show you how to build wealth for you and your family.